Welcome. This video will give beginners a good understanding of the basic concepts of insurance. At the end of this session, you would get a high-level understanding of what is risk, the concept of insurance, a brief history of insurance, how insurance works, insurance as a contract, how modern-day insurance functions, the key functions of an insurance company, life insurance, non-life, or general insurance, reinsurance, and the concept of risk. Risk is the possibility of something untoward happening in future. It's the uncertainty about future. Something that could affect an individual emotionally and/or financially. So how can we manage risks? The key risk management techniques are: avoid the risk. Example, do not ride the bike to avoid the risk of an accident. Control the risk. Example, install a burglar's alarm and security system in your house for protection against thefts. Retain the risk. Example, I might not install a costly security system in my house if I feel that my area is safe. Even in the event of a theft, I won't be at risk as I don't keep any valuables at home. Transfer the risk. Example, I buy an insurance for my car so I get reimbursed to a certain extent in the event of any accident. So, what is the purpose of insurance? It is an important risk management technique, though not the only one. The risk can be a pure risk or a speculative risk. Which type of risk can be insured? Only pure risks can be insured. Insurance is meant to cover only those risks that result in loss. A little bit about the history of insurance. Insurance was practiced by Chinese and Babylonian traders as early as the 3rd and 2nd millennia BC. Property insurance as we know it today can be traced to the Great Fire of London, which in 1666 devoured more than 13,000 houses. The Greeks and Romans in 600 BC created guilds called benevolent societies, which cared for the families of deceased members, as well as paying funeral expenses of members. Lloyd's Coffee House in the 1680s became a popular haunt for ship owners, merchants, and ship's captains, and thereby a reliable source of the latest shipping news. It became the birthplace of marine insurance. Insurance is based on the concept of risk sharing. The basic idea is to distribute the risk amongst several entities so that an individual doesn't suffer the entire loss. The law of large numbers is used in risk management and insurance to explain pooling of losses as an insurance mechanism. Thus, an increase in the number of policyholders strengthens the insurance company by reducing the probability that the pool will fail. What all do you think can be insured? Your life can be insured, and so can your health. You can insure your property, your valuables, vehicles, and several other things. Insurance works in the form of a legal contract. An individual, that is, an insured, and an insurance company, that is, an insurer, get into a contract that ensures financial reimbursement equivalent to the amount of loss to the insured by the insurer as stated in the contract for a certain amount of premium. Let us look at the various functions or departments in an insurance company and understand how they contribute to the functioning of the company. New business department is engaged in bringing new customers to the insurance company. Remember, we spoke about a large pool of insureds being critical to sharing the risks. So, new business is a very important function of an insurance company. They use a variety of channels like television commercials, print media, telemarketing, social media, agents, etc. to reach out to potential customers and showcase their insurance products. Agents perform a key role in bringing new business as they can reach out to individuals directly, make effort to develop the rapport with their customers, thus ensuring a long-term relationship between the insureds and the insurance company. An underwriter's job is to understand the risk which would be potentially insured by the insurance company. Further, the underwriter classifies the risk into categories and applies the appropriate rate of premium. If the underwriter's analysis concludes that the risk is not feasible, the insured's application may be rejected. After accepting the risk, the underwriting department would continue to monitor the risks they have accepted as a learning for future decisions. The policy administration looks after the policy documentation, endorsements, renewals, cancellations, reinstatements of the policy. Claims forms the critical function of an insurance company. The functioning of this department goes a long way in developing and maintaining customer relations and retaining existing customers. Any covered loss faced by a customer is first notified to the claims customer care, which records the first notice of loss. The case is further investigated in detail before paying or rejecting the claim. The claim process may also involve complex litigations before arriving at a final decision to pay or reject the claim. Insurance business can be broadly classified into life insurance and non-life insurance. Let's take a look at each. Life insurance insures the life of an individual. The beneficiary receives financial compensation on death of the insured. There are two major types of life insurance: term life and whole life. Term life is for a specific number of years wherein death benefit is paid only if it occurs during the policy term. Whole life, also known as permanent life, covers till the death of the insured. A term life policy can be a level term or decreasing term. In a level term, the death benefit stays the same throughout the policy term. In decreasing term, the death benefit drops towards the end of the policy term. The whole life can be a traditional whole life or universal whole life. In a traditional whole life, the death benefit and the premium remain same throughout. In a universal whole life, there are flexible premiums and death benefits. It has investment savings element. Annuities form an important part of the life business. Annuities cover the risk of outliving one's funds by way of pension plans. An insured can purchase an annuity by paying the lump sum amount and expect annuity to begin shortly from a specified date. This is known as single premium immediate annuity. The deferred annuity entails an investment phase for certain years during which a corpus is created and an income phase when the pension amount is paid at regular intervals. Non-life insurance is also known as general insurance or property and casualty insurance. It covers a broad spectrum of the insurance lines of business. It can cover health, automobiles for personal use as well as commercial use, personal property, commercial property, valuables like artwork, jewelry, etc., theft, cargo, hull, professional liabilities, and much more. Depending on what is being insured, the insurance company may issue a policy for a half-yearly or yearly term. As the insurance company grows, its risk grows. It is not a safe practice for an insurance company to assume all the risk on its own in the long run. Just like individuals who transfer risk to an insurance company, the insurance company in turn also transfers their risk to another company. This is known as reinsurance. A company may transfer different percentages of its risk to various reinsurers based on the agreements they have. Thus, all insurance companies end up sharing their risk. How does it help? It facilitates insuring of natural perils and calamities which would otherwise be uninsurable. It ensures solvency after catastrophic losses. It allows an insurer to underwrite new or unknown risks. This was Insurance in a Nutshell. If you have liked the video, please hit the like and subscribe button. Thank you.